$35.15 US. That is the number flashing on the screens right now for Treasure Global Inc., ticker symbol TGL. We are looking at a massive intraday surge of roughly $9.71, translating to a staggering 38.17% gain in a single session. If you're watching the tape, the stock is traded between a low of $35.15 and a high of $58.00 just today. Expectations for a company like Treasure Global, a microcap tech firm out of Malaysia, are usually low or centered around slow, grinding deterioration, especially given its history. Most investors expect these types of stocks to fade into obscurity or get crushed by regulatory delistings. The reality, however, is slapping the market in the face today. We are seeing a volatility explosion that defies the typical sleepy behavior of a penny stock, although calling it a penny stock at $35 might seem contradictory until you understand the mechanics at play here. This isn't just a simple earnings beat. This is a complex cocktail of financial engineering, sudden guidance updates, and a float so thin that a single large order can send the price into orbit. The reality is that TGL has become a battleground for algorithmic traders and high-risk speculators who are looking for the next momentum play. And if you are not careful, you could get caught on the wrong side of this violent move. To understand why this is happening, we have to look beyond the green percentage sign. The immediate catalyst fueling this fire is a mix of a massive reverse stock split and a very timely, almost aggressive update on their revenue targets. Just days ago, on December 5, 2025, Treasure Global executed a 1-for-20 reverse stock split. For those who are new to this, or perhaps used to the stability of something like Apple stock, or the sheer predictable momentum of Nvidia stock, a reverse split is often a red flag. It is usually a desperate maneuver to keep the share price above the $1 minimum bid requirement to stay listed on the Nasdaq. When a company does this, they are essentially gluing 20 cheap shares together to create one more expensive share. It does not change the fundamental value of the company. If you had $10 of pizza before, you still have $10 of pizza, just in fewer, larger slices. However, what it does do is drastically reduce the float, or the number of shares available to trade. When you shrink the float to roughly 800,000 or 900,000 shares, you create a supply shock. Suddenly, there is very little supply for anyone wanting to buy. If a bit of good news drops, which we will get to in a moment, demand spikes, but there are no sellers. The result? The price gaps up violently, just like we are seeing today. It's the same supply-demand mechanic that can make Tesla stock wildly volatile, but here it's happening in a microcap vacuum where the moves are exaggerated by a factor of 10. This reduced liquidity means that if you are trading this on a mobile app, perhaps using Robinhood stock trading or the Fidelity mobile app, you might see slippage. You might hit buy at 40 and get filled at 42 because the order book is so thin. This is a dangerous game for the uninitiated, yet it is exactly this danger that attracts the volume we are seeing today. Now, let's talk about the fuel they poured on this fire. While the reverse split set the stage, the company came out today, December 8, 2025, and updated their fiscal year 2026 revenue guidance. They are now targeting approximately $3 million in revenue. On the surface, $3 million might sound like a rounding error for a giant like Amazon or even a mid-cap tech firm, but for Treasure Global, this represents a projected 1,500% increase for the remainder of 2026 compared to their first quarter. They are claiming this growth will be driven by their Fintech initiatives, specifically the OXI Wallet and the Unerwa token project. This is where the narrative shifts from struggling e-commerce app to future fintech play. The market loves a good pivot, and TGL is serving one up on a silver platter. The OXI Wallet is being pitched as an institutional-grade digital asset platform. In a world where online investment and self-investing have become the norm, and where platforms from SoFi Invest to interactive brokers are racing to integrate crypto and digital assets, TGL is trying to carve out a niche in Southeast Asia. They're talking about multi-chain interoperability and managing up to $10 billion in user-held assets. That is a massive number. If they can achieve even a fraction of that, the fees generated could indeed justify a higher valuation. And this is a huge but. Investors have to ask themselves if this is real traction or just a slide deck promise. The gap between a projected 1,500% growth and the actual hard cash in the bank is where the risk lies. Let's take a step back and look at the broader picture. Treasure Global isn't just a random ticker. It operates the ZCITY App. This platform is an online-to-offline e-commerce solution. Think of it as a digital bridge. You use the app to pay at a physical restaurant or store, and you get rebates and rewards. It's a popular model in Asia, similar to how Alipay or WeChat Pay started. But TGL is doing it in Malaysia with a twist of affiliate cashback. They have a database of users, and they are trying to monetize that data by cross-selling them into this new fintech ecosystem. The logic is sound. If you have people using your app to buy chicken rice or pay for petrol, why not offer them a digital wallet or an investment product? It's the classic super app strategy that everyone from Grab to Uber has tried to perfect. However, the execution is what matters. The company has a history of burning cash. Before this reverse split, the stock was trading for pennies, decimated by a lack of profitability and constant dilution. Dilution is the enemy of the long-term shareholder. It happens when a company issues more shares to raise money, making your slice of the pie smaller. TGL has done this repeatedly. The fact that they just did a reverse split is a reminder of how much value was destroyed previously. When you look at your portfolio, perhaps on a dashboard like Schwab Intelligent Portfolios, or while checking your Fidelity IRAs, you want to see steady compounders. TGL is the opposite. It's a trading vehicle, not a set-it-and-forget-it holding. The market today is reacting to the possibility that the bleeding has stopped and the growth is starting. The updated revenue guidance to $3 million is a signal that management feels confident enough to put a number on paper. If they miss this number, the punishment will be severe, but if they hit it, the stock could have legs. This binary outcome is what makes it so fascinating to watch. It's a high-stakes poker game played with a Nasdaq listing. Speaking of stakes, I want to hear from you. Comment below how many shares of TGL you currently hold, or if you are staying far away from this volatility. Are you buying the dip or selling the rip? Let me know in the comments. We also need to consider the macro environment in Southeast Asia. The digital economy there is booming. You have a young, tech-savvy population that is skipping credit cards and going straight to digital wallets and crypto. This is the tailwind TGL is trying to catch. Unlike the US, where we have established giants like Fidelity Investments or massive adoption of Apple Pay, the market in Malaysia and Indonesia is still fragmented. There is room for a player like ZCITY to grab market share if, and only if, they have the capital to fight the marketing war. This is why the recent financing and the institutional purchase agreement mentioned in their filings are so critical. They need cash to acquire users. The acquisition of Quarters Elite, a firm with $150 million USD in assets under management, is another piece of this puzzle. It gives them a foothold in the real-world financial advisory space, potentially allowing them to upsell digital products to high-net-worth clients. But let's look at the technicals of the trade happening right now. The volume today is around 2 million shares, with a post-split float that is likely under 1 million or just around that mark. The entire float is turning over multiple times in a single day. This is classic turn. It means the shares are moving from weak hands to strong hands and then back to day traders. When you see turnover this high, technical analysis becomes a self-fulfilling prophecy. Traders on interactive brokers trading platforms or those using the advanced charts on thinkorswim are looking at the same breakout levels. The $35 level was a key support intraday. If it holds, we could see a push back to the 50s. If it breaks, the air pocket below is empty, and it could slide back to 20 very quickly. This volatility brings up an important point about choosing your brokerage. If you're trading a stock that moves 10% in 5 minutes, execution speed matters. A market order on a basic app might get you a terrible price. Limit orders are your best friend here. You might be used to the simplicity of SoFi stocks or the user-friendly interface of Robinhood Crypto, but when you're